Well, welcome everybody to the Informed Investor. I'm Mark Gochnour. I'll be joined today by Jake DeKinder and Dr. Wes Crill. Gentlemen, the topic of the day is why should I diversify in stocks outside the U.S.? So let's read a couple headlines, then we'll get into it here. The first headline, this headline came out last November, and it goes, Wall Street sees no alternative to U.S. stocks in 2025. Now here's a more recent headline. Foreign stocks are beating U.S. equities. It isn't too late to catch the wave. Wes, I'm going to start with you. Let's go back to the first headline. As we rounded out last year, U.S. stock market had done so well for several years. We're getting a lot of questions about why would I invest in stocks outside the U.S. Take us back to that time period. Some of the returns we were seeing at that time in the U.S.
Those headlines make me chuckle because it's almost the kind of thing you want to keep receipts on, because some of these predictions might not end up being very right in the end. But the S&P 500 has had a wonderful few years. I mean, just over the past 5 years, averaging 14.5% per year. That's substantially above its long-run average. We go all the way back to 1926, and when you see a return that is much higher than the long-run historical average, probably implies that things went well, or at least better than the market had expected.
Well, a lot of those were the Mag 7. They were driving that incredible performance we saw here in the U.S. You talk about unexpectedly good returns, and I even go back to the late 90s. That time period, 1995 through 1999, I think that annualized return in the S&P was about 28.6%. So phenomenal returns. As an investor, I love those returns. Who doesn't want those good returns when they're on the unexpectedly good side of that? But Jake, there's time periods where it goes the other way as well.
I like what you said there, though. I mean, you think about a lot of people that are probably listening into this. They may have a decent allocation to U.S. stocks, and to your point, they should be pumping their fist. I captured some amazing returns, but to your point, I mean, listen, with investing, we should expect the unexpected, and we've seen it on the positive side, the unexpected. We've also seen it on the negative side. You go back to the 2000 time period. Some people know that referred to as the lost decade here in the U.S., where you invested in the S&P for 10 years and you get a negative return. Go back to the late 60s into the 70s, I think 65 through 81, you get 17 years where stocks lose to treasury bills. And if you go back at the start of 65, I don't think there were a lot of people that were saying, hey, I expect over the next 17 years T-bills, quote unquote, the risk-free rate, I expect them to outperform stocks. And this is something you just have to be prepared for as an investor and accept, hey, when it's on the negative unexpected side, you got to stick to your plan. And when it's on the positive one, you probably want to stick to your plan as well.
I like how you said that, expect the unexpected. Because if you look at the range of outcomes, the calendar year returns of the S&P 500, almost rarely is it ever kind of right there in that long-run average of about 10% or so. It's always kind of out here on the high returns on the high side, or perhaps on the low side. And on the low side, we saw that tough time period too, the lost decade. 2000 through 2009, I think the S&P was about minus 0.9% over 10 years on an annualized return. So it does come in both ways there.
Completely.
Now let's shift a little bit and talk about that second headline about how returns have been very good recently when you look at the stocks compared to outside the U.S. compared to what's been going on in the U.S.
Yeah, I mean, in the U.S., contrary to what that headline might have had you believe, non-U.S. stocks have been outperforming. Non-U.S. developed stocks have been in the double digits for returns so far this year, and emerging market stocks are up pretty substantially as well. So I think it's a good reminder that we don't know where returns are going to come from. I was thinking back, you guys mentioned the lost decade in the 2000s for the U.S. underperformance. It was really easy when I started Dimensional in 2010 to encourage this idea of global diversification because we were coming out of that stretch of time. I think as we get further and further removed from the lost decade, some of those lessons have waned where people say, well, that had to have been an aberration. I'm not falling for this boogeyman of the U.S. underperforming over a long stretch. That one's really not unprecedented when we look at other markets. In fact, when you look at the worst 10-year period across 40-some odd countries, all but 7 of them have actually seen a negative return from their country's equity market over a 10-year stretch. So if it's happened before in the U.S., you mentioned the 60s as well, if it's happened in many cases across different countries, it could happen again.
Well, it brings up the point, though, about the thousands of companies that are out there outside the U.S. And Jake, when we were talking about doing this session, you made the comment that as an investor, you're investing in companies, not the countries that are out there.
I think with the argument around global diversification, that gets lost a little bit. We cite all these things, well, the U.S. has done this, and other countries have done this, and international developed and emerging markets. I mean, let's remember, you aren't investing in the countries, you're investing in companies. And just take a step back and think about that. Ask yourself, do you think that there are hardworking people in other countries working for other companies that are located there? I think the answer is probably yes, right? Do they have good ideas? Are they using technology? Are they using natural resources? They're trying to drive a profit. And I don't think that you can make the argument that somehow that is a U.S. phenomenon. And remember, that's what you are investing in. And I do like the example again about the lost decade, because we're talking about headlines. That's almost a misleading headline, because go look at the returns for international developed and emerging markets during that lost decade. To Wes's point, back in 2010, people were literally making the exact same argument that they're making today, which is, oh, I want more of what just did better. It just happened to be something different back then. But the company point is a great example. I think the other thing on the companies that might surprise people is if you really push yourself to say, here's a lot of companies or brands or products that I interact with, are they a U.S. company or are they a non-U.S. company? And when you go down that path, it surprises a lot of people.
Well, I think a lot of people tend to see, I'm just going to go buy these big U.S. brands. So, for example, I'm going to go buy Budweiser. I'm going to go buy Trader Joe's. Well, those companies are actually owned by companies outside the U.S. So to that point, you're not even sure anymore whether it is a U.S.-owned company or a brand owned by somebody outside the U.S. As well. The other thing I was thinking about that is you guys were talking is there's a tendency to chase the performance. You talked about that, where we just look at what just did well recently, and that's what we want to load up on. I think that's the point we're making here is just because something did well recently, we're not saying abandon the U.S., and we're not saying give up on stocks outside the U.S. Just sort of keep to your plan because you want to own all these companies all around the world. And I think about it, too, that as a consumer, it's almost like we're a natural diversifier as a consumer. And we kind of talked about that point about, if you walk through your pantry, you walk around your kitchen or living room, just look at the stuff that you probably bought that's been manufactured outside the U.S. or owned by companies outside the U.S. I was thinking about our dinner last night, olive oil, for example. Had a nice little Italian glass of wine.
Oh, that sounds good. How was dinner? Was it good?
It was very good. I didn't have the scotch, but that is something nice outside the U.S. Cars, a lot of us drive cars, made outside the U.S. there. So it's kind of interesting how we're very comfortable, I'll say, is diversifying our purchases and our preferences to U.S. companies as well as non-U.S. companies. And in a way, I just think about it could be similar about the way we want to own companies all around the world in our stock portfolio.
I think the other piece of that too, and we get this question a lot, is that, well, wait. All of these companies, and let's just take, so these big U.S. companies are now multinational companies, and they're generating all of these cash flows from around the world. Do I still need to diversify globally when I think about investing? When you get that question, how do you approach it?
I mean, this is testable to an extent in the data. We can look at, whether companies are getting their revenues in the U.S. versus non-U.S. countries, and then you can look at the performance of those, so-called multinational firms who are sourcing the revenue from other countries. So I guess the pretext here is that these companies would provide international diversification. Well, when you look at periods where the U.S. market is down and the non-U.S. developed indices are up, you tend to see that these U.S.-based companies with non-U.S. revenues are behaving like the home U.S. stock market. We tend to see that securities behave like their home markets rather than where the revenues are being sourced. So another one that's testable in the data does not hold up.
Well, there's also the other side of it, too, which is just like the U.S. has large multinationals, so do other countries. Again, we're investing in the companies, right? But remember, these companies that are outside of the U.S. are also generating revenues from a lot of other locations as well. So the other side of the argument was like, well, wouldn't you just go invest in all of those, right? It's a little bit of a flawed argument.
Well, let's go back in time, too, and look at some other time periods where a country's done really well and then had some challenging returns in their market subsequently. And, Jake, you always give a really good example about Japan, kind of back in the 80s. And so walk us through that one.
I think the Japanese data is really interesting. If you look at where the U.S. is currently, this is the end of 2024, it's mid-60s, right around like 65% or so of the global market cap. I mean, if I took the whole world and carved it up, about 60% of that money is located here in the U.S. from an investment standpoint. If you go back to January of 1990, you had the U.S. that was all the way down around 32%, and Japan was at 41%. Now, fast forward to today, Japan's at 5%. So you've gone from 41 Japan to 5%. And with US, you've gone from 32 to 65. And just imagine going to Tokyo back in January of 1990 and you try to make a global diversification argument. And what would you have seen? They would have said, well, Japanese stocks have done really well recently. We're incredibly strong on the global economic stage. A lot of the best products in the world are coming out of companies that are located. A lot of the innovations coming out, right? And this goes back to, with investing, expect the unexpected. I don't think there's a lot of people in Tokyo in 1990 who would have said, yeah, I think Japanese stocks are going to be roughly flat for the next 3 decades or so, right? I mean, but that again is the way that investing works. You just don't know what's going to happen.
You know what segment of the Japanese market did not struggle over that 3-decade stretch? Small cap value stocks. I think that's, when we look at the performance of the premiums this year, that's another reason why you want to be globally diversified. If you are emphasizing stocks with higher expected returns, like small cap, like value stocks, being diversified globally can increase the reliability of outcomes. That when small value is down in a given market in a period of time, like it is this year so far in the U.S., non-U.S. small cap value stocks could help right the ship.
And you can see that over extended periods too. Didn't we just look at some data looking at international developed and emerging markets small caps over a longer period, and you see a pretty healthy small cap premium there?
Yeah, I mean, people have been fretting about the size and value premiums predominant in some cases because they're looking at U.S. stock data only. Well, if you look outside the U.S., non-U.S. developed stocks, emerging market stocks, size and value have been positive over the 20-year period ending in 2024.
Yeah, and also if you took all the numbers off the table, right, and you just said, I'm going to think about investing from an intuitive standpoint. And you did a great job citing the pantry example too. But if you said, look, I've got this massive opportunity set with all of these interesting companies, hardworking people, natural resources, technology all around the world, that's one option. Or I'm simply just going to concentrate in one country. You'd probably say, well, I'm going to start with my complete opportunity set, right? But then even take it further. Say, I'm not just going to concentrate in one country. I'm just going to invest in the best performing stocks within that country. You get down to a very, very small number of names inside of your portfolio.
Well, and if you knew which ones those would be into the future, you do that all day long.
You do that all day long.
Right. But the absence of that, then, what gives you the best chance of success? And it's just sticking to your plan, staying diversified globally, and make sure you capture those returns of the markets when they present themselves.
Listen, do you think there were people at the end of that run from 65 to 81 who were like, wow, that was unexpected. I didn't expect stocks to lose. But they probably didn't completely bail on stocks. By the way, stocks went on U.S. stocks especially went on a crazy run after that, really, really strong. And you see another period. You've got an extended period in that 2000 to 2010 period where you get stocks that underperform a bond index. Do you think people are just bailing on stocks at that point? No, I think a lot of people probably saw that it was unexpected, but likely going to maybe stick to my plan.
Great comments there. Another area we get a lot of questions about as we think into the future is on a lot of economic signals out there. Different metrics out there that says, is there anything I can understand from an economic perspective that tells me what stocks are going to do into the future? And so that is going to be our next topic on the Informed Investor. Thanks for joining us today, and have a great rest of the day.